Said going in, so far what I've been trying to do is create some sort of level playing field so that everybody kind of have the same level of knowledge. And when we go forward next year and we talk about the specific instruments, that everybody already has a general idea of where this is all coming from. You might recall, if you were here last time, that one of the topics that we were talking about were credit scores. And interestingly enough, just a couple of weeks after the seminar, the survey was published that is taken about once a year about credit scores around the nation. And I'm sad to tell you that Alabama scored third to last. If it wasn't for Mississippi and Arkansas, like it normally is, Alabama would be dead last. So only Mississippi and Arkansas have worse credit scores than Alabama. And they're way below the national average. So there is certainly a need for this kind of financial education and what you should be doing with your money. Now again, today we want to talk about saving and investing. So what this is about is how do we make this financial decision? How do we get there? And then also just giving you some basic ideas on how my timing of my investing is very important. And then also how I can just do some very dirty back of the envelope calculations just to get some idea of what kind of return I'm looking at or what kind of return I can expect. So obviously, if I want to save or if I want to invest, and those are two very different things, by the way. Saving and investing are two different things. They're always used in the same sentence, but they're very different. And saving is more for short-term. Investing is for a long-term goal. Saving is a vehicle. If you do not want to lose money, you save. If you can afford to possibly lose some money, you invest. That's the difference between the two. You save, you're not going to make a lot of money, but you know for sure you're not going to lose it. If you invest, your return is going to be a lot higher, but there also is a chance of losing it. It's a basic risk and return relationship that we have that you have in investing or in finance in general. Just like if you were to go to the casino and you play roulette, now if you put your chip on red or black, there's a 50-50 chance that you're going to win. Therefore, the payout is going to be a lot less than if you put your chip on just one number, where the chance of you getting that number is much, much smaller. As a result, the payout is going to be a lot higher. And that's the general idea. If somebody comes to you and tells you, I can make you lots of money and there's no risk involved, then you know that they're lying. It's not possible. It's not possible. If you want to have high returns, if somebody tells you, I can double your money in 6 weeks, then it's probably more likely that they're going to lose all your money in 6 days. But it sounds great, and it is possible. I'm not saying that it's not possible. It's not likely, but it's certainly possible. And I always tell my students, when you can analyze projects that you should undertake, we have certain decision rule methodologies that we use, and playing the lottery is never a good decision. Now, if you do it analytically, if you do it mathematically, that would never come out to be a good decision. Tell that to the person who won $60 million jackpot. Now, they probably have a different take on that. So there's always a chance that this is going to happen, but it is very unlikely that it's going to. So for most of us, we're going to have to do the old-fashioned way, and we're just going to have to put a little bit money aside whenever we can. So we have to figure out what is it that we want to do, what are our financial goals, and then we're going to have to look at the instruments that are available to us and pick the ones that are appropriate for what we're trying to accomplish. And that's what we want to talk about tonight. So you need to have a goal. Whenever you invest, whenever you save, you need to have a goal. Saving just for the sake of putting money aside is not going to do it, because you're not going to stick to that. You need to have some sort of goal. Now, this might be a short-term goal. I want to go on vacation in the summer. I want to make a major purchase in a year or two. That's a short-term goal. I'm going to put money aside to save up for that goal. It might be finance and education, depending on if you have children, and depending on how old they are, you might want to save up some money for their college education. Now there are good ways to do it and not so good ways to do it. And again, we do live in Alabama, so anybody who has heard about the PAC program knows that there are ways where you put money aside and you think that's going to pay for your children's tuition, and it turns out that it won't. That can happen. That can happen. Now, in this particular program, there were all kinds of things that went wrong, but these things can happen. That's an investment. Because generally, you won't be able to generate a high enough return to save up the kind of money that you need to finance a college education unless you're able to put a real high amount of money aside every month. Starting a family, retirement, obviously retirement is your really long-term goal. And I mentioned that to you before, everybody can be a millionaire at retirement. It's just a matter of starting early enough. Now, everybody can be a millionaire, that is not a problem. It sounds like a lot of money, and it is a lot of money, but everybody can get there, and it doesn't matter how much money you make. It's a matter of discipline and how much money you put aside every month towards that goal. And it's tough, in particular at the beginning. The problem is with investment is, and I'll have a chart later on for you, is that most of your return is generated in the last third of the time that you invested. So if you have a, let's say, an investment horizon of 30 years, most of the return on your investment, where you can actually see your money grow, is going to happen in the last 10 years. In the first 20 years, it looks like it's never moving. And I'm putting all this money aside and my nest egg is not actually increasing. It will happen. It takes a while, because returns are the same. 10% is 10%, but 10% of $100 is very different from 10% of $100,000 in terms of dollars. And so you need to actually have money to make money. That's the golden rule of investing. You need to have money to make money. Everybody can make a 10% return, but if I only invest $100, that 10% return is $10. But if I invest $100,000, that 10% return is $10,000, which sounds much better than $10. So, but both of us have a 10% return on the investment. You just need to first pile up. So you need to be very, very patient with this. It takes a lot of self-discipline to stick to a plan. And the longer the goal is that you're looking for, the more difficult it's going to be. So you need to make it a habit. Saving and investing is a habit. Obviously, when we started all this, we talked about budgeting, and the first thing I told you is every month take 10% and put it aside before you even address all your other bills and everything. That's the spend it all versus spend a portion and save the rest approach. I can spend it all and I can live from paycheck to paycheck, and I will not save a dime. Or I can make it a habit and say, I'm going to put 10% aside, or 20 or 30, whatever I feel comfortable, but 10% is about the minimum that you should be putting aside. And if you put 10% aside every month, then that becomes a habit. And you don't even, you look at your paycheck, and when you make your budgets, you know you're going to start with 90% of it. You're never going to spend all of it. It's just like when I hear people say, well, I got the credit limit on my credit card increased, now I can finally go back to the mall. That's not the way to approach this. It's a good thing because it helps your credit if the limit on your credit card is increased, but it should not be spent. It should just be sit there, and you should be looking at it and be proud of yourself, but you shouldn't be using it. And same is true for saving. You do need to know, okay, I'm going to put this aside, and I'm never going to touch it, except for the things that I'm actually going to save it for. So if I have a goal that I'm going to go on vacation, and I put this money aside for vacation, and when the vacation time comes, I'm going to use that money to go on vacation. I'm not going to use it a month from now because I saw some clothes or some shoes that I want to buy, and I say, well, I just take it out of the vacation fund, and I'm somehow going to make it up by next summer. I guarantee you, you're not going to make it up, and you're going to miss that money at that point in time. You can't do that. And that's very, very difficult to do. Because you look around and where's money what I can spend on something? And you say, oh, I got this money set aside. Why don't you use some of that? It's not going to hurt. Retirement is even more tempting. I say, well, you know, I got like 30 more years, so if I take $10,000 out now to buy this, it's not going to matter. I'll show you later how that matters when you put money out, take money out. But generally, you need to know what is it that I want to buy, what is my investment goal, and then I need to find the appropriate tools to do it. Obviously, not every plan goes as we initially thought, you know. So we might sometimes have to modify our plan. We also have to modify our investment strategy sometimes, depending on how the market works. There's always that. So set the goals that are actually achievable. Again, if you set a goal, I want to have $1 million in 5 years. And if you only make $50,000 a year, that's not going to happen. Unless you take incredible risk or you play the lottery or something extraordinary happens to you. But it's not very satisfying if you set that goal and then 5 years from now, you're not anywhere near it. And you say, well, you know, I'm saving all this money, it's just not working. So why do I even bother? Don't do that. That's why you have to set achievable goals. Don't take unnecessary risks. If it's gone, it's gone. It's not coming back. So if you make a bad investment because somebody talked you into something, or you get those emails where they say you have this great investment for this, what they call penny stock. Those are stocks that cost you like 10, 20 cents a share, and they tell you, oh, and they're going to go up. Only have to go up to like 25 cents, and you make a boatload of money. There is a reason why they only cost 20 cents a share, and it's not because they're such wonderful investment opportunities. So, yeah. But we get these things all the time. And we need to make sure that we do not take risks. One of the things that Warren Buffett always says is that he does not invest, for example, in companies whose products he does not understand. He said, if I don't understand the product, then I'm not going to invest in it. Which is a great strategy, because you're giving your money to a company that makes a product that you might not understand. And I remember hearing a speech of a financial analyst from JP Morgan, who was the head analyst for biosciences, for the bioscience industry. The man had an MD and a PhD in biosciences. He was not a finance person. I'm a finance person. I have no idea what these companies are making. They can tell me we're this close to the next cancer drug, but I don't know if that's true or not. Because they can show me all their research results, and I have no idea what to do with that, because I don't understand that material. So they can tell me all kinds of things. That's why their head analyst for their particular industry is an MD and PhD, just happened to have his MD and PhD from UAB, that's why he came down here and talked to us. But he's an MD, PhD, and he was the head analyst for JP Morgan for that particular industry, because he understood that. You take unnecessary risks and you invest in things that you don't understand. It's really very simple, and it's worked fairly well for Warren Buffett not to invest, and it took he stayed out of all kinds of different tempting opportunities, like the big .com bubble, for example, in the late 90s. He did not invest in it because he didn't understand the business. He didn't understand the internet. And so he didn't invest in that. Served him well because everybody else lost a lot of money, he did not. Let time work for you. If you wake up every night worrying about your money, about your investments, if you have to check the price on stocks that you invested in every 10 minutes during the day, you're not investing. You are speculating. That speculating is a totally different thing. Investing, you have time. Time is on your side. You cannot get worried. Now, it's different if you read in the paper, oh, this company is on the brink of bankruptcy. Yes, you want to do something about that. You don't want to hold on to that investment. But if the market just goes down, there's no reason to panic. It's going to come back. And if you have time left, then that's not a problem. Now, grant you, the older you get, the less risk you can take, and that's why you diversify. You do not put all your eggs in one basket. You diversify your portfolio. The younger you are, the more risks you can take, because the more time you have to recover. And the closer you get to retirement, the more you take money, for example, out of the stock market and put it into less risky investments. And by the time that you are retired, there's really no reason for you to have any substantial amount of money in stocks, because that's an incredibly volatile portion of your portfolio, particularly in the last few years. And what we see in the stock market goes up and down just this week. Just this week is that, when they hear something that's remotely positive, they jump up like crazy in the stock market. I was compared that with a student that expects an F and gets a D and is all excited. That's pretty much what we see in the stock market right now. Everybody expects them to really bad, and if there's just a little bit of good news, it jumps up. But then the next day they realize it might not be an F, but it's still a D. So it's really not that good, and then it goes back down. And we've been seeing that for the past 3 years, pretty much on a daily basis. So if you have money in stock and you're retired and you have to rely on that, that's going to cost you some sleepless nights. There's no question about that. That's why you should not be invested in those kind of investments the older you get. When you're young, you're in stocks, and you shift over slowly over time into what we call fixed income securities, meaning securities that generate a fixed payment stream every month or every 6 months, depending on the payment frequency. And again, diversify. So do not only buy all stocks or all bonds, but also don't buy all your stocks in one company. That is not a good thing either. Now, some of us that work in private industry, for example, they get in their 401ks, they're like asked by their companies to buy their stock, or they're required. There was a time when, for example, which is a really bad example, Enron. We all know what happened to Enron. It went bankrupt and had all kinds of issues. But they're forced their employees, or required, I should say, their employees, to invest 80% of their money in their 401k plan into Enron stock. Now, when the company went bust, so went their 401k plans. Now, there was no diversification in that portfolio, because all the money was invested in one company's stock. So you can feel loyal about the company that you work for, and you should. That doesn't mean that you should put all your money in there. Now, you should diversify your investments so that if something happens, you at least have something else that still has its value. So you want to diversify, make sure that you spread your investment out over different investments. And as Katie said at the beginning, we will talk about these different kind of investments, and what's a mutual fund, what to look for, what is a stock, what is a bond. We're going to talk about them in the new year. We're going to spend significant amount of time on that, in particular on mutual fund, because that, by the end of the day, is the most appropriate investment strategy for most of us, to invest in mutual funds rather than in individual stocks or individual securities. So we're going to spend a lot of time doing this. Right now, I'm just trying to give a general idea. What's happening? I found this incredibly interesting. About 62% of all households in this country have money in some sort of low-interest savings account for about $1 trillion. There's $1 trillion worth of money sitting in low-interest account. If you just shift it over in an investment vehicle that makes extra 3%, you could generate an extra $30 billion. If you go in a Series 1 savings bond, these households could generate an extra $50 billion in interest every year. So there's a lot of people that have their money where it's not supposed to be. You should have money in a savings account if you have a short-term goal. You do not put your money in a savings account if you're saving for retirement. You're leaving all that money on the table. That is money that you could have, but you're not having it because you're not investing in the appropriate vehicle. That's why you need to know What is it that I'm saving for or investing for? And then what's the vehicle that I should be using for that particular goal? And by the way, a Series 1 savings bond is a risk-free investment. Those are savings bonds that you can get from the Treasury. By the way, starting January 1st, you cannot get savings bond at your local bank anymore.
If you what?
Starting January 1st, you used to that you could buy savings bonds at your bank. You will not be able to do that anymore starting January 1st. You have to go through the web. It's all online starting January 1st to treasurydirect.org. That's the website for the Treasury. If you want to buy savings bonds, they do not give you the paper ones anymore, because that saves them a lot of money by not doing this, and it's a policy of the Treasury to do as much electronically as they can. So they will not give you any paper. It used to be that you could get them, like, you know, at baptisms or whatever, give another gift when a kid is born. Won't be able to do that. Won't be able to do that. They do not actually hand out the paper ones anymore starting January 1st. They said it saves them, I forgot how many, like $50 million a year or something to not do that, in terms of printing and, you know, they're not, and mailing and all that kind of stuff, which means that banks will not be able to sell them. But a Series 1 savings bond is the most common kind of savings bond. It generates a fairly good return. Right now, I think it's close to, even now where interest rates are really low, this example is a little outdated with the 50 billion. Right now, I think a savings bond has a 3.1% interest, which is not a bad interest considering it's risk-free. You have to hold it for at least 5 years. If you get the money out prior to 5 years, you have to pay a penalty equal to the last 3 interest payments that it would have earned. Otherwise, after 5 years, you can always sell it back to the Treasury. You can sell it back to the Treasury and get your money plus interest out. That's so it's a fairly good, fairly safe investment. If you have a 5-year investment plan, for example, or a savings plan, you want to buy something in 5 years, 3% safe is not a bad deal. It's not a bad deal at all. Again, that's a risk-free investment. Any kind of Treasury securities are considered risk-free. They are for the moment. So and they've always been considered risk-free, because the government, the U.S. government, has never defaulted on their debt, ever. Have never missed a payment. In the history of the United States, the U.S. government has never missed a payment on its financial obligations. That can Treasury bills, Treasury bonds, yes, anything that's issued by the U.S. Treasury, the U.S. Department of Treasury, has never defaulted.
So this is the federal amount of the state or something. Some state that they bankruptcy.
No, as far as the government concerned, there's no worries. No worries. No, you don't have to worry about that. Yeah, there's a lot of people saying a lot of things, but no. You don't have to worry about this as long as the government can issue debt, and they do that every week. And there's about 3 to 4 more people that want those securities than the government has to offer. You don't have to worry about this, and that's pretty much where we are right now. It's not that they can't get them issued anymore. They're about 3 times oversubscribed, these issues. Again, every week the government issues new securities because they need money. Every week, every Monday, every Thursday. Then once a month the longer term, and once a quarter the 30-year bonds. Every time that happens, there's no problem so far. And I don't see that changing anytime soon. Okay, now this might be, I don't know if you can see that on, you have it on the thing too. It's a little small. These are just saving and investing. What's your objective? Saving is for short-term needs and emergencies, and investing is for long-term growth. What do you invest in? Or savings vehicles, rather, savings account, money market account, CDs. We talked about those when we talked about banks last time. These are safe because they are FDIC insured. Obviously, there's a limit that applies. They're up to $250,000. They're insured, meaning there is no risk to lose your money. Now, you might not get the interest if you invest in a CD and the bank goes under, which hardly ever, by the way, happens. We hear about all these banks going under, but they're not actually going under. They're just being taken over by somebody else, and all you get is you get your account statement from somebody, from a bank that has a different name, but nothing actually happens to your particular deposits. But if that ever were to happen, the FDIC, which is the Federal Deposit Insurance Corporation, insures all transaction deposits up to $250,000. So you get at least your money back. Again, you might not get your interest, but you at least get the money back, that your capital back. Again, I don't even remember the last time there was a bank that just disappeared where the depositors actually did not get just rolled over the deposits to a different bank. Because that normally doesn't happen. Yes?
And what is the FDIC backed by? Is it backed by paper money that we print, or is it backed by gold or silver or platinum? What?
No, the FDIC is backed by the I guess, as I say, the good faith of the government. So it's effectively backed by the taxpayers. That's what it's backed by.
So it's not backed by gold, anything that's solid. That
No. We've long abolished the gold standard. We have not done that since 1972 because it caused a lot more trouble than it helped, and because we had enormous amounts of inflation, enormous problems with the gold standard up to 1972.
I asked that because I'm concerned. I know Venezuela withdrew on last week. I think it was 212 tons of gold out of European and American banks. And I know that our money is not backed by gold anymore, just like you just said, because it was released in the 30s. And so if the FDIC fails, if the government fails, and the FDIC, how do we have, it's still not a guarantee 100%.
Well, nothing is ever 100%.
Well, gold is. Gold is. Solid gold or platinum and silver.
Well,
you got
gold, any kind of security, whatever it is, it's based on what somebody's willing to pay for it. Just because it's gold, it doesn't have a value. It has a value because somebody likes gold and believes that it has a value. That's, because gold doesn't do anything. It doesn't feed you, it doesn't generate any heat, it doesn't drive your car. So gold doesn't do anything for you. It just sits there and looks pretty. So there's got to be somebody who puts a value to it. If there's no value to it, that's why, for example, the countries that have gold are not throwing it all on the market at the same time. South Africa has enough gold to flood the market for years, and same is true for diamonds. They would never do that. It doesn't make any sense for them to do that. Venezuela is a very different situation from the US. The one thing you have to look at, just like with anything else, look at the economic power of the United States, what backs the United States government, and what backs the taxing power of the government is based on what the economy can generate, and this is the largest economy in the world. So there's really nothing to worry about. Now the FDIC, just like the Treasury, has never failed to make a payment on any account. At the same time, as I mentioned, when a bank goes under, it's being taken over by another bank. It does not disappear. We're not in the 30s anymore. That's why the FDIC was created. We're not in the Great Depression where you had bank runs because the bank went under, your money was gone. These things don't happen anymore. It took a while, and when the financial crisis in 2008 started, there were a lot of people that were concerned, and there were people lining up outside some of these banks that went under for no reason. There was no reason, no rational reason. Now, obviously, when it comes to your money, you don't necessarily always act rational. But one of the things that I always tell people is, if you have concerns about the money in your account, go to an ATM machine that does not belong to your bank. If that ATM machine still spits out money to you, you have nothing to worry about. Now, they're not going to give you any money if they don't think that they're going to get it back. So therefore, if that ATM machine from a different bank still gives you the money, you're fine. And the thing is, there was with IndyMac Bank, for example, in Washington Mutual, those two big banks that went under, and people were lining up around the block to get their money. The problem with that is your money is safe. Withdrawing money from a bank that's in trouble makes things even worse. And it's the worst thing you can do to the bank is actually pull the money out. I think everybody here probably has seen It's a Wonderful Life, which is a great story about bank runs and what not to do, and a story about where the money is that's in your house and in his house. That's exactly how this works. And you can't just pull it out like that. That makes it worse. That makes a bad situation worse. There's nothing for anybody to worry about the banking system in terms of getting your money out. Now, there are some banks out there that might be in some trouble. We'll see. There is obviously some things going on in the world, but there's nothing to worry about. There's so much at stake in Europe, for example, for European countries that they would never drop that currency. It's not going to happen. I'm from Europe, and I can promise you that will never happen. They like to talk about it because they like to play power games, but it's never going to happen. Because there's too much at stake for the big countries. If they were to lose the euro, that would be a disaster for all of these countries. So they will do whatever they will try, whatever they can to make that. They might kick out a country here and there, like Greece. Should have done that a few years ago. But that's a different story. Well, the fact is, we would not even be talking about this if Greece did not have the euro. Otherwise, nobody would be talking about this. Because when Iceland went bankrupt, nobody cared. Because nobody was affected by that. So, but there's really, not so much to worry about. It's mostly politics, and it will work its way out. It will work itself out. Now, the benefit of the safe investment is that it's or the bank investment is safe and accessible, but you get low returns. And long term, your returns are probably going to be lower than the rate of inflation. That's at least historically the case. That inflation has outpaced the returns on those safe investments. In other words, in terms of purchasing power, you might actually lose money. If you put your money in a savings account for 30 years, you actually can buy less for your money 30 years from now than what you could have bought with that amount of money today that you're putting aside. So that's why you need to actually invest over long term into some sort of vehicle that outpaces inflation, where you actually generate a real return. So long-term growth, stocks, bonds, mutual funds, all kinds of different investment products depending on what you like to do. They pay you interest, they pay you dividends, they go up in value. Unfortunately, they can only go down, also go down and down. There's risk involved, there's variability. You can possibly lose all your money. That is normally not the case in most of the investments that you can invest in. But there are investments out there where that could possibly happen. But those are the ones that none of us should put their money in to begin with. But there is risk. There is risk, and anybody who's been invested in the stock market recently and looked at the stock market, in 2008, the stock market, you lost about 30% of your money just in the fall of 2008. Now, some of it has come back, some of it has not, depending on what you invested in. But, some companies have done very well. If you had invested your money in Apple, you'd be fine. It's, some companies do well, others did not so well. If you had invested your money in Citicorp, you would not do very well. So there is also, that's why for an individual, it is very difficult to pick individual stocks, because the amount of time and analysis that goes into individual companies is mostly beyond what most of us can understand or want to understand, and takes a lot more time than most of us have or want to spend on all that. That's why mutual funds are so popular. Now here's the pyramid of investment risk. There you can see whereas the base is the low risk and the summit is the high risk. The high risk are the ones where you can pretty much lose all your money. Options, futures, those are called derivatives because their value is derived from other underlying asset. I don't want to go into any more of this. Effectively, just stay away from those as far as you can. There's no reason for anybody in this room to invest their money in options or futures. Leave that to professionals and professional speculators, and there are lots of them out there. We need them; they keep the markets going. But you don't want a piece of it. Collectibles, the same thing. The problem, you can believe all you want that I have this really rare baseball card, and I know it's worth $100,000. It's only worth what somebody is willing to pay for it. And if you want to sell it and the best offer is $100, then guess what? The value of that baseball card is $100. Even if you believe it's $100,000, it doesn't matter. It's worth whatever the market is paying for it. And for collectibles, that is very difficult. Not to mention that it's incredibly difficult to sell those. Now there's not so many people, there's not a real easy outlet to buy and sell these things. So collectibles are a nice thing and they're nice to have, but for most of us, we should not be buying collectibles as an investment vehicle. That's just not a good idea. Middle risk, we have the real estate. Some would argue that the risk of real estate might be a little more than middle by now, but historically it has not been. One of the things that we have to understand is that we're looking back what happened in the last 10 years, and we're thinking of the real estate market, of this market that just shot up and then it dropped. But prior to that, real estate increased in value by about 2-3% per year. That's all it was. It was a fairly safe, steady investment that you would get out of real estate. Then the market got crazy. There's no other way to put it, and in some places crazier than others. And it went down. I remember I moved here from upstate New York, and I lived in upstate New York for 3 years. And I bought a house when I got there, and I sold the house when I left. And I left in 2007. And I got 30% more for my house than what I paid for it. And I hadn't done a thing to the house except for adding a deck. That's the only thing that I did to that house in 3 years. But it increased the value by 30%. And I was saying back then, of course I'm taking the money, but that's not sustainable. Why would the value go up by 30% if nothing happened to the area? It's not that there's a big employer moved there and created thousands of jobs so people needed to move there, or that I did something to the house to make it nicer. I didn't do anything except for a deck, and the deck was not worth 30% of the value of the house. The rest of it was just hype. That's all it was. And eventually all of that burst. In some places worse than others. If you had bought a house in Vegas 10 years ago, it was 50% of what it was worth when you bought it. Same is true for Florida, parts of California, and some other parts of the country. That's unfortunately what happened. Now I think there is a lesson learned from that, and hopefully that won't happen again. But you can never say never. Money is tight right now. It's interesting to see that the real estate market is down, even though interest rates are historically low. Normally what you see is that when interest rates are low, real estate prices go up because everybody can afford to buy a house, because they can afford bigger mortgages because interest rates are low. Right now, we have a situation that we never had before: low home prices and low mortgage rates. They have never been lower. This is the lowest historically ever since they were been recorded. Now, we've only been recording mortgage rates since the late 60s, so they might have been lower before then. I don't know, but we've been recording that since the late 60s, and they have never been lower than what they are now. So this is a great time right now to buy a home. There has never been a better time to buy a home. They're cheap, and the money is cheap as well. There's no better combination as far as buying real estate is concerned. Equity mutual funds, large small cap stocks, high income bonds, debt. These are all securities that we will talk about in the upcoming session. So we will talk about all of these middle investments. And then the base, the low risk, I mentioned the CDs, treasury notes, treasury bills, money market accounts, government bonds in general. Now, I'm talking federal government. As we all know, living in Jefferson County, municipal debt is not risk-free. And municipalities do go bankrupt. And municipalities do default on their debt. So when we're talking government, we're talking federal government. Any other kind of government debt can very well default. And as we know from own experiences here in the county that we live, it does default. So that's the low risk. Now again, you could put another arrow on the next to the high risk, low risk, which says high return and low return. Because high risk generates high return. Low risk is going to generate low returns. You cannot expect a high return investing in the base. If you want to get the highest possible return, you're going to have to invest in the summit. At the same time, you're taking by far the highest amount of risk. And you have to be aware of that. As Milton Friedman said, there's no such thing as a free lunch. And there isn't. See, even tonight, you have to listen to me to eat. Even this one is not free. If you could just walk in, take your food and walk out, and even then it wouldn't be free because you have to spend the time to come over here. So there is no such thing as a free lunch. If you want something, you're going to have to pay for it. And if you want to have high return on your investment, you're going to have to take the risk to make that happen. Now, I'm not saying that, for example, investment in options is a bad investment. If you know what you're doing, if you have the stomach for the risk that you take. It's just not something that I would necessarily recommend. But if you have some extra money sitting around saying, I want to try that, that's fine, just be prepared. That's money that you better not need for anything else. Because there's very high risk, but you might find yourself making a lot of money in a very short period of time. It's possible. Again, it's not likely, but it's possible. And as long as you earn a high return with your high risk, it's a fine investment. Where it becomes a bad investment is if you have high risk and low return, then it's a bad investment. If you're taking a lot of risk and you still don't get anything out of it, that's a bad investment. That you don't want to do. So if you're up at the summit and the top part of the pyramid, you want to get a high return. If you're on the bottom, you are going to get a low return. Do not expect a high return on a low risk investment. It's not going to happen. If you invest all your money in treasury securities, they are as safe as they can be. There's nothing safer. Right now, at this point in time, nothing safer in terms of investment than investing your money in treasury securities. But a 20, a 30, or 60-day treasury bill or a 12 months treasury bill pays you 0.3% right now. Yes?
If one buys these government bonds that have a term before you could cash them in, and one doesn't survive those years, how do your heirs profit from the investment?
Well, what happens is if you own those, then they're going to be passed on. The ownership is going to be passed on to your heirs, so they're going to have them. Now, what these bonds do, they pay a coupon, which is an interest payment that they pay the government with every 6 months. Every 6 months, they pay you a coupon, and that coupon is going to be paid out to whoever is the owner of the bond. So if the ownership is going to be passed on to your heirs, all they're going to do is they're going to change the name on the record. And they're going to put somebody else's name there, or they can be sold and just cashed in, and you get just all the money back. Okay. And government bonds, they are incredibly liquid, meaning there is no problem whatsoever to sell them at any point. This by far the most liquid market that we have is the government bond market. Liquid meaning that you can sell it quickly and without any discount. Now that's what liquid means. So the more liquid an asset, the easier you can turn it into cash at a very low price, at a very low cost. So, for example, if you want to sell a government bond, you can do that if you know how within 30 seconds.
Oh gosh!
If you wanted to sell a house, you're not going to be able to do that in 30 seconds. Now, if you wanted to do it in 30 seconds, you would have to give a very large discount on the value of your home to make that happen. So that's why a home is not a particularly liquid investment. Or if you have a priced baseball card and you want to sell that, you're not going to be able to do that within 30 seconds. If you wanted to do that within a day, you would have to offer it to somebody at maybe 50% or 40% of the value that you think it's worth, and then somebody might be willing to buy it from you that fast. That makes it a very illiquid investment. So government bonds, stocks, bonds in general are all very liquid investments. So there is no problem. If any of you has ever bought any securities through an online broker, for example, all you got to do is type in what you want to buy, you press a button, within a minute your order is executed and you have the securities. That's liquidity. You don't have to worry about these things. Other securities, again, collectibles, it's a different story because there's no market for it. There's not a central marketplace. We have a central marketplace for stocks. It's called a stock exchange. It's called NASDAQ or the New York Stock Exchange. It's a central marketplace where everybody goes who wants to buy and sell those stocks. There's a central marketplace for government securities where everybody goes. If I want to buy and sell government securities, I know where to go. And it's a quick, there's lots of people that want to buy and sell them, and they all communicate with each other. There's only very few people that want to buy this Van Gogh that you have hanging in your basement. There's very few people that want to buy that. And they are very difficult to find. So that's why that is a very difficult investment to sell. It's beautiful to look at, and it certainly has a great value, but it's not a value that can be actually realized, where you can say, well, I really need that money now. You will not be able to do this. And that's one of the big thing about liquidity or about your investment portfolio. If you keep it liquid, then you know, or in liquid securities, then you know that if I really need that money, if there's some emergency, I can always sell out of there without any trouble. And that's where these securities, and we'll talk about how markets work in general in the next session. That's the next session, how markets work and how they're regulated. And how we actually get to the market and how we buy and sell these securities. Now, here's something that I wanted to show you. You have two investors. They both can invest their money at 9%. Now, investor one starts at 25 and puts $2,000 away every year until they're 65. At that 9% return, that person is going to have $805,000. Which is not a bad thing considering you're only putting $80,000 away. 40 times 2,000 is only $80,000. You're putting you have 40 years, 25 to 65, it's 40 years, $42,000 payments, that's $80,000. You're turning it into $800,000. But look also at it, after 10 years, you only have $33,000. See, it's all the way towards the end where really the what we call compounding is kicking in, earning the interest on the interest. That's when this kicks in. Now look at investor B. Investor B said, well, I'm 25, I don't have to worry about retirement yet. I'm too young to worry about that. So, so move on for another 10 years, says, oh, now I'm going to invest. Now, since I missed the first 5 years or 10 years or maybe because now I'm making more money, I'm going to put $4,000 away. I'm going to put twice as much away as I would have, as my friend did at 25. And guess what? I'm only going to have $594,000. I'm only 10 years later and I'm giving them twice as much. Now, also mind you, I'm now having here 30 years at $4,000. That's $120,000. I'm putting $120,000 away and I'm still coming up with less than the person who put $80,000 in over a 40-year period versus a 30-year period. If you wanted to make the same return because you missed the first, or come up with the same future value, the same $800,000, you would have to put away $5,418 every year if you start 10 years later. That is more than twice. And that's when I'm talking about patience. When I'm talking about starting as early and as soon as you possibly can. Because every year counts. This is only 10 years. Look at the difference that it makes. That's the power of compounding. Time value of money. It works for you. That's the beauty of this whole thing. It works for you. You don't have to do anything. You just put it aside and it's going to do all its work for you. And after 40 years now, 9%, and 9% is not that high. It's not that, oh, how do you get 9% consistently over 40 years? That's really not that high. That is not an outrageous return to earn. In particular, if you have most of your money invested in the stock market, you will be able to do that. Not, if you look at it year by year, you might be 1 year where you had 50%, 1 year where it was 5, 1 year might have been 20, 1 year might have been 0. But over the 40 years, you're averaging 9%, and you're ending up with $805,000. By just putting $2,000 away a year, this is not a month, this is not per week or per day, this is every year. Just one $2,000 payment once a year. That's a little bit more than $100 a month. That's all it is. That's why I said, everybody can be a millionaire. No, you just add this, you just increase this. You, instead of you're putting $3,000 a year away, you have $1 million after 40 years. Yes?
Why you put the contribution? Is it on the bank or you open the account for annuity, or you put it in the stock market?
It depends. I'm not specifying where it goes. Just assuming a 9% return. Now. $2,000, for example, you can put that $2,000 in an IRA account, which also gives you get a tax, so that it's not even taxable, and you can take the money out. By the way, speaking of taxable, when I talked about the Series 1 bonds, there's no state income tax on the interest that you earn on those bonds, and if you use those bonds for educational expenses, there's no federal tax charged on the interest that you earn either. So they are one of those savings vehicles that are used for saving for children's education. Because if you pay tuition with by selling the bonds, you pay tuition. You do not have to pay taxes, federal or state, on the interest that you earn. Because otherwise, every interest that you earn money in, obviously, you're going to have to pay taxes on. I mean, every interest. Now, if this is an IRA or a retirement account, you do not have to pay taxes on this until you actually retire and pull the money out. You know, there's no taxes being paid during those 40 years. Now, once you pull money out, then you're going to have to pay taxes. But generally speaking, most of us have a much lower tax rate when they retire than when they're working. And therefore, you pay less taxes once you retire, and therefore you're not being taxed as highly, but you are being taxed on the money that you withdraw. And depending on where the money goes, if it's a pension fund, there are restrictions on if you can take it out, when you can take it out, all these kind of things. What you don't want to do in a situation like that is, for example, you are in year 30, you're 34 years old, and say, I really need $30,000 to buy a new car. I have $30,000 in my retirement account. I still got 30 years left before I retire. I just take that money out. You take that money out and you continue on at $2,000. You're going to be somewhere around $400,000. You're giving away half of your money by taking out $30,000 10 years in. That's why you don't want to touch that money. And it is so tempting. It is so tempting to touch it, but you do not want to. Because that dollar, every dollar that sits there is going to make you money. The longer it sits there, the more money it's going to make for you. And there's nothing you have to do. You just leave it there. You just push it out there every month. You put some money in there, and you can do that automatically. You know, your employer can pull it out of your paycheck and put it in your 401k or your IRA account, whatever. And you never actually get to see it, and it just works for you. And the longer it works, the better it's going to be. And if you take that money out, even the smallest amount is going to set you back for years. Because you basically have to start over. And as I mentioned to you before, it grows very, very slowly. If you look at it, you know, after 5 years, I've paid in $10,000, I only have $16,000. But after 40 years, I've paid in $70,000 more, but look, I have $740,000 more in wealth. So compounding is a powerful force, but it only works if there's actually interest earned that can earn more interest. That's why you can never touch that money. That's very important. And then the last thing I want to talk about, just like a basic, it's, you know, back of the envelope, rule of thumb kind of thing, the rule of 72. It's a very basic calculation on how long does it take to double my money. You take 72 and you divide it by the interest rate. And that gives you how many years it takes. In this example, if you have 8, you can make 8%. 72 divided by 8 equals 9. So if you can make 8%, it will take you 9 years to double your money. So those $1,000 are going to be $2,000 9 years from now. So you would have turned, but then think about, well, that's not very good. But then those $2,000, 9 years later, are going to be 4. 9 years after that, they're going to be 8, then 16, and 32, because the interest doubles too. And that's why towards the end, that's when you really start making money on this. Yes.
At the end of 9 years, the $2,000 purchase power is the same as the $1,000 at the 0 year.
The purchasing power of this $2,000, that depends on what the rate of inflation is. You know, if at the same time we have an 8% rate of inflation annually, then the 8% that you earn are basically going to be consumed away by inflation. So that means the purchasing power of the $2,000 equal to the purchasing power of $1,000. That's why the number one goal of the Federal Reserve is to keep inflation down. That's the number one goal of monetary policy, is to keep inflation down. That's why we do not have high inflation in this country. Now, also what would happen is that if inflation were to be 8%, the interest that you could actually earn on them would be higher than that. Because when inflation goes up, interest rates go up. Because people need to earn a real rate of return, meaning there's got to be some increase in purchasing power. If they do not, then they're not going to give you the money. And whenever you invest your money, that means you're giving it to somebody. It's not just it's just disappearing in a black hole. If you're investing money, if you invest in the stock market, if you give in the bond market, you actually give that money to somebody who needs it. When you buy a treasury bond, the reason why there are treasury bonds out there is because the government needs money. If there's ever a day that the government doesn't need any money in excess to what they collect in taxes, they will not issue any more government bonds. I don't foresee that to happen anytime soon, but that would be the case. The only reason why they have to issue bonds is because they spend more than what they take in. They have to borrow money. So in order to make sure that somebody is actually going to give them the money, they're going to have to give you an interest rate that exceeds the rate of inflation. Otherwise, people would not accept that bond. Why would I give you my money for 30 years, and then when I get my money back 30 years from now, it's worth less than what it was before? That doesn't make any sense, and I'm better off spending it right now. That's why you have to have a real, and that's what they call it, it's a real interest rate. That's the difference between the interest rate that you earn on your investment and the rate of inflation. That's called a real interest rate. You're going to have a positive real interest rate for people in the market to be enticed to actually give you their money. Because that's what you do. When you invest, you give somebody your money, and they'll do something with it. If you give it to the bank, they're going to make loans with it. If you give it to the stock market, the company that issued the stock is going to use the money to invest, make capital expenditures. If you buy a bond, that's a loan. So somebody is going to use that money and they needed a loan, so that's why they're borrowing money from you. So whenever you invest, you're giving somebody money, and in order for them, for you to give it to them, they're going to have to offer you something that sounds good to you. Now that's how the market works. The market, the rates, the returns that you earn in the market are driven by the people who give the money, not by the people who need the money. That's how a market works. You go to the bank and you want a loan, you cannot go to the bank and say, well, I need a loan, I'm willing to pay you 5% interest on the loan that you give me. The bank's going to laugh at you and say, okay, that's nice, but guess what? If you pay us 8, you're not going to get it. No? Because the people who give money are the ones that dictate the terms. And so the investor who puts the money in the market is the one that dictates the terms, not the one that needs the market, the money. So therefore, if inflation was high, rates were high. In 1980, you got 14% on the Treasury security in 1980. Why? Because we had a rate of inflation of 12. Now that's why you got 14%. Now, you don't get 14% right now, because we don't have a rate of inflation that high. Now, and inflation is always a tricky subject because it always depends on what you look at. Purchasing power is driven, our rate of inflation is driven by energy cost and housing cost, first and foremost. So if you don't have a car, for example, half of what drives inflation does not even affect you. So if you hear an inflation figure, it encompasses everything. It encompasses a whole basket of goods. If you don't use half the goods that are in the basket, then your personal rate of inflation might be very different. But the market takes that overall figure as such. Now, right now, lately, what we've seen is an early increase in also grocery prices, in food prices. That also has gone up very significantly, and that affects everybody. But if you see an increase in some other cost, if you see an increase in rents, for example, rents are going up. If you don't rent an apartment, then it's nothing that really affects you, but it's going to be overall reported in the rate of inflation. So that's the. But this is just a really nice, easy way, just to get some idea. how long it will take to double my money. Yes.
I hate to seem to be a pessimist, but you know the formulas look good, and I've seen the Rule 72. But at your university, University of Alabama, Birmingham, right?
Yes.
I saw a film there that you can get on Amazon called Inside Job. And when I look at this and I think about the vehicles and I look at what happened at AG, when I looked at the predators, I have to call them what they are, and I look at the people that were under Bush that caused the collapse that, you know, for the bailout under Bush, and then Obama hired the same predators that caused the fallout. And so how would I know, because they raided pension funds, how would I know that whatever I invest in is going to give me the return that people tell me? Because when you look at the congressional hearings, when you look at the fact that he's hired the same crooks that Bush had in there, I don't have any guarantees. These people are what I think the definition of a psychopath is: one that will do something that hurts people and they have no conscience. And that's what I saw in the congressional hearings, because they asked one of them, you used the term that you were selling S to the people, and he said, well, I sold them what they asked for. He said, yeah, but you said they were junk. This is a person with no conscience, and these are the people that Bush had, and Obama brought Timothy Geithner and other folks right back in. So how do I know that the rule that you gave, based on maybe whether it's 6%, I know you have some instruments that will pay 6% insurance companies, but how do I know that I'm going to be safe still? If it's still, and we know we're not backed by gold or silver, and I know what you said about that. That's my question.
Well,
It was called Inside Job, just in case you hadn't seen the movie.
I mean, the thing about all of this is that, you know, the idea behind what's done in the market in terms of regulation and supervision is to create confidence in the market. Obviously, if we get in a situation where nobody believes in anything anymore and says that everybody just takes your money and runs with it, then the whole market is going to collapse. That is not in the best interest of the people that take your money to run with it, and that's not in the best interest of this country. It's because our economy needs your money. You know, it's really that simple. So I'm not convinced that that things are as bad as they look now. There have been a lot of bad business decisions made.
Much worse.
There's a lot of bad business decisions made, and a lot of them have been driven by bad incentive systems in those industries. Now you get what you pay for, but and there are certain people that have certain ideas, and we'll see what happens. There's certainly true that there's a lot of things that happened in this market that caused what we see now. Now, with everything, there's always two sides to everything. There's somebody who sells and somebody who buys. So there's the same with the housing market. There's somebody who gave you a bad mortgage that you shouldn't have, but there's also somebody who signed those papers. So there's two sides. Nobody put a gun to anybody's head either. You know, they were obviously convinced sometimes on facts that were not particularly true or overstated. But if the country or the world loses confidence in the financial markets, then we have chaos. You know, that's what we've been trying to do over the last few years to restore that confidence. And sometimes, in order to do that, things have to be done that might not make sense on the surface. It might look like we're bailing out the same people that got us there in the first place. Which what we did is we did have to bail out some of the banks. That is absolutely correct. The problem is that we're in a situation that we've never been in before. And the problem is, it's just like when you're in the hospital and you have a patient with a rare disease. You know, you can say, well, I can try this treatment and see if it works, or I can do nothing and see what happens. The problem is, you might think, at least if I try treatment, I have a better chance that something good happens if I just let him sit there. And the problem is we cannot test these in the laboratory. Now, we cannot say, okay, we're trying this and then see what happens, because we don't know what would have happened if the bailout had not taken place. We just don't know. And anybody who says that they do, I don't know what their